Good afternoon. You're watching Business Plus. The US Federal Reserve on Wednesday decided to raise interest rates by 25 basis points, expressing caution about the recent banking crisis and indicating that hikes are nearing an end. The increase takes the benchmark federal fund rate to the target range between 4.75 to 5%. Now, along with its ninth hike since March of 2022, the Federal Open Market Committee, FOMC, noted that future increases are not assured and will depend largely on incoming data. Remember, a sharp increase in interest rates since last year has led to strains in the banking system. Two US banks, Silicon Valley and Signature Bank, collapsed this month, buckling in part due to problems caused by higher interest rates. Fed Chair Jerome Powell acknowledged the recent events in the banking system that likely resulted in tightening credit condition, and that was likely why central bank's tone has also softened as of today. I have with me Karthik joining us in the newsroom. Karthik, the US Central Bank has raised interest rates again despite fears that the move would fuel or could lead to further, dampening turmoil in the US banking system.
Of course, I think it's a very tight rope that US Fed is also walking on, because look at both sides of the rope that they're walking on. On one side, you've got a brewing financial instability, a financial crisis, so to speak, while on the other side, you've got high inflation. So the last time I remember a 5% interest rate in the US was perhaps in 2007. And if you look at the scenario back then in 2007 and today when we are sitting in 2023, 15 years hence, they were dealing with a financial bubble building up. It was a subprime crisis then, and they were dealing with high inflation. The Fed kept increasing rates, as a result of which there was liquidity that got sucked out of the markets. At that time, it got invested in real estate, and then the subprime crisis sort of, that bubble went up and eventually bust, because the real value of the mortgage was not as high as what the bank's exposure to the real estate market was. So I fear it's a very tight rope that the US Fed is walking right now, and 5% is a fairly high interest rate. What really comes to mind is, and this is something in fact that I read this morning, Sanjeev Sanyal had also quoted, that is the responsibility of tackling inflation solely with the central bank in any government. Should US and thereby even other countries including India look at fiscal measures rather than monetary measures? I think that is what we should try to explore. Okay, we will explore that. Suman Chaudhary, who is the Chief Analytical Officer of Equity Ratings, is joining us. I will come to you, Suman, in just a bit. But Karthik, Wednesday's rate hike is 9th in a row, and it lifts key interest rates, as I said, 4.75 to 5%, up from nearly 1% a year ago, the highest level since 2007. So, essentially what we were discussing this morning, it's a repeat of history for the US Fed, a choice between taming inflation and containing the crisis. Absolutely. You're asking me or asking Suman? I can begin with you and then move to Suman. So exactly. So 2007 is when we saw this, and 2007, of course, financial instability for a different reason, the property bubble, the real estate subprime crisis that happened, and at the same time there was high inflation, 5% high interest rate. 15 years later, we are in the same situation, and we know what happened 1 year after 2007. 2008 was the big Lehman moment, the real Lehman Brothers crisis, and the entire meltdown of the system. Now, there have been talks and there have been speculations and data suggesting that that the economic turmoil is not too far away. How much can the Fed keep doing to contain that and to really prevent that from happening? Because there's only this much runway that the Fed also has. What do you do beyond 5%? Maybe one more rate hike, maybe another 25 basis points. What beyond that? Okay, it still remains a debate. Suman, I want you to come in there. What exactly can US Fed do? That is the question.
Well, I think it's a very difficult choice, honestly, for the Fed. They're working on a very, kind of a thin rope at this point in time. Already they had enough problems at their hand, when it was very sticky inflation, which is not coming down in a hurry. And as Karthik mentioned, rates, if you look at the last 1 year, since last April, May to now, the rates have virtually gone up by 5%. Effectively, the rates were near zero. And now it has kind of come to 5% in US. Now, that is the genesis of the whole, if you see the banking problem that we are also seeing, the very sharp rise in interest rates. So, the point is they're already dealing with that, that they had to increase interest rates like this because of the sticky inflation. On the another side, they have this banking issue now coming up, which is creating a problem, a crisis of confidence in a way in the banking system. Although I would say it is nowhere near the scale of what happened in the global financial crisis in 2008. This is much more, at this point, it seems it's much more manageable. The confidence to control it seems to be higher. And that is the reason the Fed didn't go for a pause. They decided that they will have to focus on controlling inflation. So they have again hiked the rates and kind of bringing it closer to 5%. But I think the question is that will this solve the problem, or is this kind of helping to stem inflation? Difficult to say. I think the medicine has to be taken. If you go by classical economic theory, monetary policy has to act, which is what the Fed is doing. But yes, the government also has to play a role. Fiscal, I agree that fiscal policy is also important. You see, the liquidity part is getting taken care of. So more quantitative tightening is happening. The government also has to spend less. There has to be less of money supply. All these factors have to work together. But this is, yes, there is a medicine, but is there a side effect? The answer is yes, there is also a side effect, because you risk kind of having a problem on retail loans because interest rates are going up so fast. The economy may slow down. So these are problems that the economy has to go through. So I see that it's not something that the Fed can do easily. It has to go the path of monetary tightening. But yes, there will be side effects, and I think the economy has to be prepared for that.
Okay. Karan is also joining us, Karan Maharshi, who's an economic commentator. I think point well taken, it's a bitter pill, but inflation numbers there suggest that inflation is not falling as rapidly as analysts would have expected despite consecutive rate hikes. So what exactly is happening as far as consumer prices is concerned? It's still 6% and higher than a year ago. So the consecutive hikes there not really helping tame inflation. Karan?
Yeah, hi, thanks for having me. So the primary problem pertains to core inflation, as I understand, and that excludes fuel and food. So therefore, I see two reasons for this problem. One, supply chain issues have been unable to meet pent-up demand post-COVID. And second, rising protectionism has restricted imports from countries such as China, resulting in the sourcing of goods and services from the domestic market within the US. This has stoked the inflationary tendencies, and they are becoming sticky at this point in time. And I think that is why consecutive rate hikes are not helping the problem.
Okay, thanks, Karan. Suman, help us understand, how does the balance between the monetary policy tightening and the fiscal policy tightening work? Why is it that any time inflation is seen to be sticky, come what may, the first port of call is always the central bank, and not enough is done on the fiscal side?
Yeah, I think, I wouldn't say, that things are not done. So if you look at, for example, in India, for example, if I take the case of India, today, one of the issues in inflation in India is food prices. And there has been the recent case of cereal prices going out of control and needs to be controlled. If you see the government on the fiscal side, some measures have been taken. Earlier steps were taken when oil seeds, edible oil prices had gone up, when pulses prices had gone up. There were some measures that had been taken, and I think the government on the fiscal side, those kind of measures to address the price rise, those will be taken. Whether they're enough to address the issue is another question. But definitely fiscal policy, the right way to do this is to have a proper coordination between a monetary policy and fiscal policy. That goes without saying. Uh, the other point here is that you also have to recognize that these are very difficult times and these are unprecedented times. As Karan also mentioned, that we have gone through a very difficult and a prolonged pandemic, and where there was supply chain, what happened was unprecedented. So there was supply chain issues and supply chains broke down. So we have a real problem at hand where inflation is not really coming down, or it's coming down, but it's coming down very gradually. So these are not problems which can be solved, overnight. And the other issue I think we are all concerned about, and I think Karan will also agree, the risk of stagflation. What we say, that there is a kind of a slowdown in growth, but inflation is also not coming down in a hurry. So high inflation, low growth kind of regime, which is kind of a pretty dangerous scenario for the whole world. I think that's the risk that we should be cautious about.
So, Suman, if I can borrow your medicine analogy, is it fair to suggest that fiscal tightening is like having multivitamins? The results are not immediate; the results are prolonged. You sort of build that immunity against inflation with fiscal measures, whereas monetary measures are more SOS. You pop a pill and you hope some magic is going to relieve you of your pain immediately. Is that a fair analogy to take?
I think that's a pretty good analogy. Yes, fiscal measures are necessary, and actually, you should. A good doctor will always give you the both things, right? They will give you the pills and they will give you some vitamins also to kind of make your body a little stronger. Yeah, I think that's a pretty
So
good
let's
analogy.
come back home now. Let's come back to India. We've seen that we are pretty much towing the line of the Fed. Every time there's a rate hike, we follow up with a rate hike of our own. And inflation continues to be sticky for us back home in India as well. How much should RBI also continue tightening the screws? Does it make sense for India to again follow the footsteps of the Fed Reserve and tighten maybe another 25 basis points or something? Because inflation is not going anywhere in India as well. It continues to be sticky.
Yeah. So I think, at least in our opinion, the likelihood of RBI going for another 25 basis point hike is pretty high. There is obviously, we have seen the example of Fed not willing to pause despite the kind of turbulence we are seeing in the banking sector there. So I think, given the numbers that we have already seen, inflation numbers in January and February, almost 6.5 average, which makes it, RBI's forecast was 5.7% for this quarter. It's definitely going to be above 6%. So, and 6% is the Lakshman Rekha, right, for inflation. So I think there is a strong case for 25 basis points hike, which will also happen. The question is, what will be the statement on, or the kind of path going forward? Uh, so that's something that's not very clear. I think it will be, as they say, data driven. They will look at the data and decide, but at least I am not very sure that they will be so confident to kind of put forward a pause at this point in time. So
Right.
it will
Karan?
depend on the data, I think, going forward, whatever actions. But 25 basis points to me looks given at this point in time in April.
Got it. Got it. Thanks, Suman. Karan, let me come to you. So, Suman had just mentioned stagflation and that being a real and present likely scenario in the US where there are high interest rates and slow economic growth. Do you think that is really something that the US is heading towards? And if it does happen, how does it percolate down to the rest of the world, including India, but not limited to India?
Well, the understanding here is that the US Fed is in a reputation management mode at this time. So, what that means is that the US Fed has realized that it was behind the curve when it came to assessing inflationary tendencies. building an economy over the previous 2 years. And now that the US Fed can no longer manage expectations as the headline and core CPI numbers continue to hover over the 6%. I mean, the target is around 2%, but they're hovering over 6%. The consensus is that it must give a recessionary shock to the economy. And there are really no alternatives here. So as things stand, given the sticky inflation and the solid job numbers, I think that the terminal rate in the US can actually be higher than the 5.1% consensus. As far as the tax rate is concerned, I think that's the reason why they will continue to raise rates, irrespective of what is happening in the macroeconomy in terms of the banking crisis, and consumer confidence will eventually fall.
Okay. And Suman, if I can come to you, I understand it may not be a sector that you or data that you track very closely, but specifically again in the Indian context, we talked about fiscal measures. How much of that really will be in our control? We've seen oil prices have cooled off globally, but beyond that, monsoon is not expected to be great. And overall, we are living in an interdependent world where it's not just our problems we have to deal with, we've got to deal with problems of the rest of the world as well. So how much of this is actually in the realm of possibility to control from the India perspective?
I think in the kind of global environment that we live with, I guess a lot of it is not within our control. But if your example, Karthik, I will take on oil. I think one good thing that has happened is, as you may be aware, that India has the share of imports of oil. One of the reasons why our oil imports have become cheaper. One thing is, of course, the global prices have seen a moderation. But the other thing is that we are increasingly importing a higher share of from Russia, right? Our basket has more Russian oil today, which is cheaper, which comes at a discount. I think that's also I attribute that to one of the as one of the successes of the government. So that's something that we are trying to do. But if oil prices tomorrow, because of any geopolitical issue, again goes up, I think that will not be under control. I think these are facts of life today, that there are a lot of global headwinds. With the Indian economy, the good news is that we are a domestic-driven economy. It's not export-driven like some of the other Southeast Asian economies. So we are not so impacted by global headwinds. We are, but not to that extent. I think that is an advantage that we have, and that makes us having the potential to grow at one of the largest rates, at a higher rate than some other big economies. I think that's where we are. But yes, we have our own problems. The first problem is the point that we're talking about inflation not coming down steadily. Food, some categories of food are giving a challenge. How we control that is going to be an issue. And I think the next part is, how do you really drive private sector investments? How do you, in this environment, how do we increase private sector capital expenditure? I think that's something that the government has to really work with the industry to make it going. There are many programs that, PLI programs that have been announced, but we'll have to see how it actually translates into investments on the ground. I think that is what is going to define our medium-term growth potential.
Okay.
Agree with you completely, Suman. Thanks so much, Suman.
All right, Suman, thanks very much for joining us. We're going to move on now. Shifting focus to news coming in from auto sector. India's largest car maker Maruti Suzuki is hiking prices for the second time this year. It had earlier increased car prices in January by 1.1%. The company cited it has been forced to hike prices as it continues to witness increased cost pressures driven by overall inflation and regulatory requirements. Already reeling under impact of chip shortage, the current development is further set to dampen customer sentiments. We have with us Shashank Srivastava, who's the Senior Executive Officer, Marketing and Sales at Maruti Suzuki. Shashank, the latest price hike is another blow for customers. How long is the cycle going to continue? Okay, we don't have Shashank. I think we've lost him. I want to come to you at this point, Karthik. Price hike on top of waiting period. It appears that auto sector and especially car users are going to have to wait longer to buy their favorite vehicle.
Honestly, I love the confidence of car makers in the country because I think they live in such a wonderful scenario right now where there are enough and more people in India with excellent disposable incomes because car prices have been expensive to supply. But I think the car makers are in a great place where there are so many takers and so many people wanting to buy their cars, making advance bookings even before they've test driven a car, even before a car has actually been launched. That car makers, and Shashank is here with us.
Shashank is here.
That car makers, I feel, are in a happy place that that people like us are willing to spend money, and yeah, I think increasing it by 1% or 2% every now and then is definitely not hurting them. Am I right, Shashank?
No, you are absolutely wrong.
Oh my God. Okay.
Okay, if it's not to your benefit,
Because
what exactly do you contribute it to?
No, actually, when we get a little misled by the number of pending bookings, which is often quoted in the media, and those are pertaining to some specific models, and the pending is not necessarily because of very large demand, but because on the supply side for the last 1.5 years, in fact from August 21 onwards, we have had this semiconductor supply situation, and that's what has led to the building up of these pending bookings. So a large number of these bookings will be multiple bookings across manufacturers, across dealers, and across models. So we really don't know what is the real demand. And as I see, we have seen the inflow of the new bookings is what is a much better demand parameter. And there I have seen some bit of softening starting from mid of February. And I think that's because of the higher inflation, which has led to the repo rates being increased, which have now started coming into the bank loan rates for auto. And as you know, 80% of the auto sales is through bank financing. So I think a couple of other red flags also coming up. Basically, the El Nino effect, which probably would affect the rural sentiment and also probably the agricultural income. And both these two factors probably can have the potential to have a lower demand patterns going forward.
Okay.
I was going to ask you about the increasing interest rates, Shashank. That is bound to hurt the auto industry, right? Because loans have become expensive. But have you seen any correlation between rising interest rates and demand, the order book that you are receiving on a month-on-month basis?
Not really, because I've seen the last few quarters, the demand was steady despite the increased interest rate. But then the interest rates have started coming into the auto loan, that is the pass-through has started happening only now. So we can't really be sure about that. And in any case, I think there has also been a pent-up demand, which we have observed for the last 2.5 years, thanks to COVID. We have seen, for example, this year you'll read there is the highest ever sales in the industry, 3.9 million probably by March end. But when you compare it with last year, of course, it's 26% up. But when you compare it with 2018-19, it's only about 14% up. So 14% growth in about 4 or 5 years is just around 3% CAGR, which isn't really as good as what you were saying that we were sitting pretty.
Okay. You talked about regulatory requirements putting cost pressure. Can you tell us what are you doing to navigate that area?
Yeah, so really we have to obviously conform to whatever is the regulatory requirement. And from April 1st, we have the RD norms coming in along with OBD2 norms. Most of our vehicles, we've already built in those spec changes to conform to the new norms. And that has led to that cost pressure, which we have indicated in our stock exchange filing. Obviously, the other thing is the commodity prices, while they have moderated a little bit in the last 2 quarters, but if you compare it with what they were 2 years back, they are still quite, it's still quite high compared with what they were 2 years back. The entire price the price hike hasn't been taken care of all the commodity price increases, because we were very afraid during the COVID times about whether the demand should not be negatively impacted. As market leaders, we are very conscious about the demand in the industry, not coming down. We are like sort of responsible for the overall demand also in that sense. Therefore, the price hikes which have happened and which was referred to, there have been about 6-7 price hikes in the 1.5 years, is really not taking care of the entire commodity price increase, which have been immense when you compare it with 2 years back. Steel, for example, 38 rupees a kg, is still around 65, 68.
So has that impacted your margins, or are the price hikes that we are seeing
Yes.
right now trying to offset the losses that, not the losses, but the reduced margins that you may be operating on?
Yes, yes. So if you see the last couple of years, if you peruse our balance sheet, the profitability has been less, purely on vehicle sale terms.
But in absolute terms, because you're saying there's still a growth, right? There has been a 3%, 4% CAGR, so on reduced margins but higher volumes. Do you feel that the mood of the economy is still good? The fact that whether it is post-pandemic pent-up demand or not, auto sales are always considered as the barometer to gauge the mood of the economy. And auto sales have been ebbing up only. I don't remember seeing any time, except for, of course, the peak of COVID that we were in. Apart from that, we've seen that that sales have been rising only. So overall, it reflects that the economy is in a good shape.
Also, if you could tell us how your order book is looking like right now.
Yeah, so you are right. Actually, the auto industry volumes very closely related to the overall economic growth. And that is what we have seen this year, 26% growth. That's pretty good. As I said, however, compared with the peaks that we saw in 18, 19, not so great. But yes, the sales have been increasing because it's a growing economy, and we have always seen, with the example of other nations which were in a similar situation earlier, like Mexico, Brazil, South Korea, and such countries. We have seen that if there is economic growth, yes, auto industry should do well. And that is what we are hoping for. And in any case, we are looking at a 5 to 7% growth for the industry next year, 4.05 million to 4.1 million from the current levels of 3.9 million that we expect the March to close.
And has the hybrid mindset really, do you see that kicking into the Indian consumer? Of course, diesel was something you discontinued some time ago, and petrol was the only option you had until you just recently introduced hybrid. So do you think the hybrid mindset in India is growing and we can see the country progressing towards cleaner fuel? Do numbers reflect that change in mindset?
Yes, absolutely. The hybrid has picked on well.
Are you driving in a hybrid right now? I see you're on the road, you're in a car. Are you in the Grand Vitara?
Absolutely.
The hybrid one?
Actually, yes, I am in the Grand Vitara.
That was a good guess.
In the hybrid, and I think you are right. It's the strong hybrid vehicle that I am using, and it's giving great fuel efficiency. I mean, I'm getting 25 plus kilometers. Situation, actually, it was at his nadir in August 21, where we could produce only 40% of our plant production. Went up to about current levels of 94, 95. But the shortage still persists. We lost about 46,000 vehicles in Q3. We lost some vehicles in Jan, Feb as well. March is going to be worse than Jan, Feb. But that chip shortage is now related to a few models. And it is those few models that we are not able to supply and that have seen longer waiting periods and the pending bookings.
Okay. And do you see the second-hand car market at some point denting your market share and denting your business?
Actually, no, because we do see that, in the new car buyers, about 25% of the new car buyers is exchange, upgradation, replacement buying. And that means that a increase in used car would also entail a increased replacement car buying. And that should help the overall industry, definitely. So actually, it's not really hurting in any sense, except that at the lower end of the segment, probably the people might upgrade from a two-wheeler a little after a longer period than what they were doing earlier. And we do see some pressure on the lower end of the spectrum as far as passenger vehicles is concerned.
What are your plans in the electric vehicle segment?
So electric vehicle segment, we have unveiled our first EV called the EVX very recently in the Auto Expo, and which should be in production in the financial year 24-25, which is not very far from now. We do expect that the EV penetration in our country will increase to around 17% by 2030. And 2024-25, I believe, is that inflection point where after 2 or 3% of the penetration, you see this penetration suddenly going up for EVs. That's the experience in most other markets in the world.
Okay, 24-25 is the expectation. Yes. I want to get you on your message for customers who are exasperated at this point, long waiting periods, high prices. Any message that you have to give to your customers?
First of all, we apologize for that waiting, and we are trying to quickly put in place and hope that, and we are trying our best to increase our production in those models. There are other models which are available readily, but for those customers waiting for our other models where the waiting list is long, we do request for their understanding and assure them that we are making all efforts to bring their favorite cars as quickly as possible to them.
All right, Shashank, thanks very much for joining us with all those details. Appreciate your time.
Thank you. Thank you very much.
And moving on, a scathing report on Adani put Hindenburg on the global map, and while Adani lost 12 lakh crore in fortune, Hindenburg became the talk of the town. Now, after targeting the business empire of Gautam Adani in January, Hindenburg has announced that it is coming up with another big one today. While speculations are rife across social media on who the big one could be, we take a look at what does Hindenburg do, its modus operandi in its attacks. Joining me in the newsroom is my colleague Amit, also with me Suyash. I want to come to Amit Kumar, who's also going to be joining us very, very shortly. But Amit Ranjan, first to you. Although Hindenburg has been all over the news lately, for the uninitiated, who is Hindenburg and what do they do?
Thank you, Shweta. Hindenburg Research is a New York-based short seller. They were established by a certain Nathan Anderson in 2017. What is curious about them is they are still, if reports are to be believed, only less than 10 people on their employee roster. They have targeted 30 companies since 2020. Each of these companies' stocks fell 15% the day after Hindenburg targeted them. 6 months down the line, these companies' stocks were down 26%. Mm-hmm. That's their achievement ratio, if you may call it. Now, how do they operate? They research their target, then they place bets on their targets decline. After that, they use their extensive social media network to publicize their research on these targets. Hindenburg's Twitter handle has around 270,000 followers. Anderson's Twitter handle alone has around 27,000 followers. So that's their modus operandi to begin with for the layman.
Okay. Suyash is also here. Suyash, could you explain to us what is short selling bet? We talked a lot about short selling in the recent past month, but what exactly is short selling?
So Shweta, the very essence of short selling is that you are betting on the price of the stock to fall. Okay. Now we follow the same old commandment of, buying low and selling high. We just reverse it and we sell high and then we buy it at a lower price. So now you may be wondering, how can we sell something that we don't even own? Mm-hmm. So let me first help you understand what the mechanics of the trade are, and then we'll get to how it works out in the market. So suppose you have identified a stock that you want to short. You will go to your broker, borrow the said stock, sell it in the go to the open market and sell it. Now hopefully when the price has fallen, you'll buy it back and you'll make a profit and you'll return the stock to your broker again. So let's say you have identified a stock and you were able to sell the borrowed stock for rupees 100. Now the stock has fallen and now it's at rupees 90. So you buy it back and your profit on this short trade would be rupees 10. So at this point, I would want to point out that in the cash segment, you can't short sell a stock. The only way to do is through on an intraday basis. So basically, you have to square off your trade within the same trading session. What you can do is short it in the derivative segment through futures and options.
Okay. Amit Kumar is also with us. Amit, how ethical is short selling? Because short sellers like Hindenburg are also in trade and they stand to benefit from the price fall. And at the end of the day, most of what they're saying is essentially speculation.
Yeah. Hi, thanks for having me. So I think, there is a lot of context around short selling as unethical. I think that's a sort of a little naive way of looking at it, because short selling is very common in US. It's not so much in India because the regulator SEBI has actually banned short selling. You can sell a little bit through the SLB mechanism, stock lending and borrowing mechanism, but that's less than 5% of the short selling which happens. You can short it through futures and options, but that's a very expensive way of shorting it, because one lot of FNO stock is about 5 to 10 lakhs. So you have to put a margin. But in US, the short selling is very common. And most importantly, there are no circuit limits. So actually, a stock can fall 100% also in one day. So there are a lot of companies who specializes in doing research on companies which are overblown or very expensive, or there is a downright fraud in them. And they release a research report according to which you can actually short the stocks. So Hindenburg is not one of them. There are tons of them in the US. Muddy Waters is one of the famous ones. There have been a few OTT documentaries also made into how Muddy Waters have shorted the stocks before. Yeah, Hindenburg specializes in sort of providing a negative research report, just like a lot of these companies provide a buy stock report.
So Amit, what I want to ask you is that short sellers like Hindenburg, they are going on this big press tour, and what they are actually saying, most of it is still speculation. So that is where the unethical point comes in. What do you think?
So Suyesh, I don't think, it's right currently for us to speculate, because we don't know whether it's an Indian company or a foreign company. We don't know whether they are going long or a little short. I mean, given their track record, obviously they are going short on it. And I don't think there is really any unethical, because eventually if they are shorting, it's their money. They expect to make profit out of it. We don't really question anyone who goes long in a stock and the stock tanks. So why this ethical dilemma about someone shorting a stock and the stock going down? And it's not that they have been right all the time. They, in the past 6 years, since 2017, they have released about 17 reports, out of which I think only 60% of them have been correct. And the stock has actually fallen. Some of them have actually risen, and they have to book losses also on them. So it works both ways. It just does not just work in one way.
Okay. So Yash, what are some of the biggest bets of Hindenburg apart from Adani? Since we're talking about all the 16 bets that Hindenburg has placed, run us through what are the biggest bets.
So before the Adani row, Hindenburg was probably most known for its 2020 bet against Nikola. So Nikola was this auto company that promised to transform the world, save the world from climate change with its natural gas fueled semi-trucks. So now get this, at one point, Nikola was more valuable than Ford without even selling a single truck. See, so what happens now is in September 2020, Hindenburg accuses Nikola of being, and I quote, an intricate fraud largely perpetrated by its founder Trevor Milton. Although the company did hit back and threatened to take legal actions, calling the claims false and misleading, Milton announced his resignation within 10 days. Less than a year later, the US authorities have now charged Milton with 3 counts of criminal fraud. The issue is still ongoing.
Okay. Amit Ranjan, what about some of the lesser talked about targets?
Okay, there's a list of them. I'll touch upon a few. There was this company, Lordstown Motors, valued at 5 billion. Post Hindenburg's targeting them, their stock went down 90%. Workhouse Group, another EV company, they were 1.5 billion. They were a 1.5 billion company. After Hindenburg targeted them, they went down to 332 million. Twitter, this is a curious one. Hindenburg bet both ways on their decline and on their rise. This was before Elon Musk took over. This Twitter stock went into a frenzy, going up and down, swinging up and down. Post Hindenburg releasing their report on Twitter, the stock went down from 49.8 to 37.39. And after that, of course, Elon Musk came in, and the rest is history. DraftKings, Clover Health, all of them lost 60 to 70%. So there is a list of them. Their average, like I said, is the stocks go down 15% on an average post the Hindenburg reveal. And of course, the latest one and the most popular one in India has been Adani.
Okay. Amit, I want to quickly run our viewers through what exactly happened in case of Adani. Quickly summarize for us, what did Hindenburg do and how did Adani ended up losing billions in his currency and billions in fortune?
So let's assume that we are on 23rd February 2023 and the Hindenburg report was not there. Now, if you take the period before that, for the last at least 3 years since COVID, you can see that a lot of these stocks which are listed on the exchanges, they've gone up multi-fold. Now, one of the reasons of the stocks really moving up was obviously the free float, which we call it, where the retail investors or the institutional investors can come and actually buy the stock. That was very less. So the stock, on a very low volume buying actually went up a lot. Secondly, a lot of this growth by Adani companies, whether it is in the Adani renewable space or Adani Power or even Adani Enterprises, a lot of this was a debt-fueled growth, which means they were getting funding from various financial institutions, and they were using that to buy more assets, buy more companies, bid for more projects, etc., etc. Now, one can argue that a lot of this funding was not from the Indian banks or the Indian financial institutions, but outside India. But that was happening. Now, the concern, some of the research analysts or some of the advisors, like us, have in the market that this debt-fueled growth is not sustainable, and that's why a lot of us did not actually invest it. In fact, mutual funds really did not invest it in Adani stocks, except where they have to compulsory buy in an index. And the reason for that is you're not sure whether that growth is going to sustain, especially in a rising interest rate environment. Because what happens is your profitability, declines when the interest rates rises. And especially when the interest rates have risen almost 500 basis points in the last 1 year itself, and you are not able to service that debt. So the interest becomes too much, and then the profitability is less than that. So that sort of leads to leveraging of the balance sheets. So a lot of the analysts were not sure whether that deleveraging of the balance sheets will happen post this fiasco. So as far as the content of the Hindenburg research report was concerned, I don't think it was had anything big that analysts haven't covered before. All of them knew that there was a free float which is very low. There is a debt-fueled growth which is happening, and the valuations are skyrocket high. But when the report came, that sort of became a trigger for selling of these reports or selling of these stocks. And as a result, the mass destruction in the stock prices happen because people are not convinced on the street that Adani can continue to be funded, Adani companies can continue to be funded, and they can actually handle this kind of debt which they have taken on their balance sheets.
Okay, and the short selling bet, it still stands, Amit?
We don't have an idea. When Hindenburg has released the report on 23rd January, they have already taken positions in Adani bonds. Remember, these positions were not in India, but the Adani bonds, which were listed in the US, they have taken short positions in them. Given the liquidity situation in these Adani bonds, our sense is that it would have taken anywhere between 9 to 12 months to actually build some substantial position in these bonds. So their positions were not in India, and they haven't given any sort of confirmation or a validation that they have closed the positions.
Amit, one of the major points that Hindenburg pointed out was the valuations were stretched, right? A lot of these companies are still turning profitable. So maybe in the next 2-3 years, if they could have continued on the same trajectory, the valuations would have seemed reasonable. What do you think of it?
So, Suish, key word here is sustainable. When the debt is high and the interest rates are high, you are not sure, how much you can fund that debt fueled growth. And that's what the concern was there essentially with most of the Adani companies. So even though, you can keep a stock high because of valuations, because it can justify that growth trajectory over the next few years. But once there is a doubt on that growth trajectory, which was the case in this Adani fiasco, then I think stock or the market participants would have a second thought on it. And if you look at the targets which the Hindenburg report has given, most of the targets have been actually met.
So Amit, the big question is, can Adani bounce back?
Or will Adani bounce back?
Yeah.
All of that, of course, is going to be speculation, but your take, sir.
So yeah, as you rightly said, it's pretty much speculation. What I am most interested in understanding is that how they are going to fund it. Because if you look at the last 2 months, they have postponed or cancelled a lot of projects and a lot of investments which they were actually doing it. Whether it is in the data centers or the invest works, etc., etc. In fact, they have deleveraged also a lot of positions on the stock exchange. Where they have taken pledge positions against stock prices and taken debt, they have actually, unraveled that also, especially in ACC and Ambuja Cements. So I think for them, the biggest challenge going forward is the fact that how they are going to get the funding. If they are not going to get the funding, then I think the growth will be very slow and will not match up to the expectations which we had before the release of the Hindenburg report. But if they are able to get a funding, then it's a different matter. Then we have to reevaluate. But given the high interest rate scenario, my personal sense is that next 6 months are very critical for Adani Group of companies.
Amit, you had mentioned that it is in speculation whether the next one will be from India or abroad. Do you have any guesses, or what? Do you have anything you feel? Who is the next target?
And just to add to that, what's the chatter that you're picking up? I'm just going to, as an advisory, put it out there. I know it's all in the realm of speculation. I know we can't say for sure, but given its past record, given Hindenburg's past record, has it targeted 2 companies in the same country previously? And if yes, are you hoping that this could be from India? What are you picking up? Broad guesses.
So they have picked countries from stocks or the companies from the same country. They've picked companies from China. They've picked companies from the US itself. So I don't think it will be the first time they are going to pick a company from India again, if that happens. My guess is as good as yours, But my sense is that it could be, it's just a random wild guess, but it could be one of the regional banks in US which are facing a lot of deposits outflow issues, currently, and a lot of these are funded. Give a lot of funding in the US. So if the regional banks are responsible for almost like 80% commercial real estate lending in the US, almost 50% of the consumer lending. So the deposits are actually going out of them to the big banks, and there is a shift of deposits from the smaller regional banks to the large banks. So there could be an immediate credit crunch there, and I think could be that Hindenburg is, trying to attack. Trying to take this as an investment thesis and trying to short one of the regional big banks, small banks. Sorry.
Regional, small bank, that is obviously speculation, chatter that we're picking up on the street, that it could be one of the regional US bank, given that the banking crisis has already, really brought down hopes of customers, consumers, investors. This could be a double whammy if Hindenburg decides to place a bet on one of the regional banks in the US. Amit, thanks very much for joining us with all those details. We will, of course, keep tracking that very important story and bring you all the latest updates whenever Hindenburg releases its big report. But that's all we have in this bulletin. Thanks for watching.